The new federal government tax increases are a huge deal. They're voting on it right now, and a lot is changing. Thank you for joining us here on Wealth Protector TV. My guest is the founder and senior managing partner of the asset protection, estate planning, business planning firm, Barth Calderon, Harry Barth. He is going to break down for you what is going on right now that you need to know about. Let's go take a listen. Hi, everybody. This is Paul Hitchcock with Barth Calderon, and welcome to Wealth Protector TV. Very excited to have our founder of Barth Calderon and senior managing partner, Harry Barth, with us today. Welcome, Harry.
Welcome. Glad to be here, Paul.
Yeah, well, we're going to jump right into this. It is on the new tax planning changes coming out of Washington. Harry, I know there's a lot going on. We can't wait to hear.
All right. Well, I have a lot to take everybody through. And let's please understand where we are on the train that's heading on the tax train. So first of all, for everybody to understand, this is not yet enacted into law. So last time I spoke with all of our people, we spoke about the 95-5 Act that was introduced into the Senate, which was actually quite draconian. Today, we're going to talk a little bit about the 831-page document that was submitted by the House Ways and Means Committee for their tax changes as well. I'm a fan of having absolutely nothing change. I'm not so sure that this tax act is beneficial in any way, shape, or form for our constituency. And again, please understand that what's going to happen. I'll try to compare and contrast between the two. Eventually, the Senate and the House Ways and Means Committee bills will get reconciled. That'll be beat up a little bit by various different lobbyists and hopefully some moderation, and eventually arrive at a point where enough of our representatives, senators, and president may be able to sign the bill.
Is this over the next few weeks, Harry, or what's the timing?
Well, that the biggest crapshoot, and it has something to do with what happens at a Ways and Means, is when this will happen. It could happen lightning fast over a weekend, or it can not happen at all till 2022. So we don't know. It's idle speculation. I would think we have a little bit of time to go, but let's talk about time. Time is very important. For the vast majority of the Tax Act that we're going to talk about today, as introduced by Ways and Means, it becomes into effect on January 1st, 2022.
Okay.
However, there are two aspects of the Ways and Means, actually three aspects of Ways and Means Committee bill that happened before that, which we will talk about. One of them is the discontinuance of intra-family discounts on transfers, which I'll talk about in a little while. The other one is a significant modification to the use of grantor trusts in estate planning that I'll talk about. And three, which is quite insidious, is there is a raise in the capital gains tax rate from the current 20% to 25%. And that actually they're trying to make retroactive to transactions occurring after September 13th, 2021. So a new transaction being entered into today, they would like to impose the new 25% tax rate on capital gains. Now, whether or not that gets adopted into law in that form, we don't know, but that is what's in the House Ways and Means Committee bill. So let's start a little bit and talk about income tax. Seems to be we have some unification between Senate bill and the House Ways and Means Committee bill on income tax, creating a new, it's a 39.6% tax bracket. So for everyone earning over $400,000 in 2022, the federal tax rate will become a 39.6%, up from the current, I think, the 37% that we currently have. So that's one change. I think that there's a very good chance of the adaptation of the 39.6% rate. But unto itself, it's not alone in what it does. So we add that in with a increase in capital gains tax rates from 20% to 25%, effective September 13th, 2021. There is a grandfathered period for a transaction that has been binding before this September 21st, 2021, but not yet completed, will be at the old rate, but a new. So if today you and I entered into a contract to sell my business, that would be, if this is enacted, at the new 25% rate. I don't think that's right. Don't think it's fair. It just doesn't make much sense. But this is forewarned is forearmed. One of the things that is interesting is there is, as we all know, there's been, in addition to the regular income taxes that we paid in the past, we had if you earned over, let's go at $400,000, and you had passive income, which was, interest, dividends, and gains, there was an additional 3% net investment income tax on those earnings. So if we had $100,000 of net investment income, in addition to our regular ordinary income tax on that, it was 3%. So insidiously in the House Ways and Means Committee bill, they are broadening the definition of net investment income to include all of the distributable income from any source that comes out over $400,000. Wow. So for those that have S corporations, partnerships, and others, you distribute over $400,000 of distributions, they would like to oppose an additional 3% tax. So on those dollars, we're coming in at over 42% federal tax. Not much is talked about that. Then there is another thing that they're working on, and that is if one has income, not many people do, but income of greater than $5 million, an additional 3% surcharge on all income over $5 million. So, and a narrowing of the 199A exemption that we have for S corporations is all part of this bill. So, as far as I'm concerned, we will see, more likely than not, a good percentage of these income tax increases be enacted into law if the law gets enacted. There's still going to be some horse trading in between, right? But I see that. There's also another thing I understand it, but I don't quite go for it, is that there is an all-out attack on IRA owners that have greater than $10 million of assets in their Roth IRAs or IRAs, forcing them to pretty much disgorge everything above that and start paying tax on it, even though that wasn't the deal with the government in the first place.
You don't think that's going to happen?
I don't know if that's going to happen. It affects not a lot of people. Not a lot of people have retirement plans greater than 10 million, but there are some people that have $1 billion in their retirement plan, $200 million in their retirement plan, and they're going to want those to come out of the Roth and not be able to add any more, and a whole attack on that, on basically limiting the uses of retirement plans, again, thinking that is a abuse of the very rich. Some of the other concerns that I have is that built into the House Ways and Means Committee bill is something that has an impact on the retirement industry in another way. Many of our clients and many people have engaged in the utilization of self-directed IRAs. Right. They have self-directed IRAs so they can invest in startups and invest in
property.
Right. We'll call it Main Street investments rather than Wall Street investments. Instead of the typical stocks, bonds, cash, ETFs of Wall Street, is be able to really invest in real estate programs and energy related programs and other types of programs, which for many people have been more profitable or at least different. Basically under the new law, um, those types of investments that would require a private placement memorandum, accredited investors, and the use of self-directed IRAs, which is most of the industry, would no longer be allowed.
Wow.
So that would kind of push everything into Wall Street and away from Main Street. I hope that does not get adopted.
Jeez.
But we have a mindset that we have an attack on the ability to, use the laws that were put into place by Congress. So the other thing that I think that's really important to understand is the hiring, spending $80 billion on IRS enforcement agents under this bill, on the hopes of sending out 87,000 new IRS enforcement agents, because the concept is that they believe that almost everyone of wealth is cheating somehow on the taxes, and that can raise $100 billion worth of taxes by having the IRS increase audits and scrutiny of everybody's tax return. So I think that those are a lot of things. Now, there are some things that I'm very pleased about that were not in the Ways and Means Committee. The elimination of step up and basis on death doesn't appear to be there. No changes in charitable tools, which I think become very, very important next year, except for this year, the utilization of what we call a grantor charitable lead annuity trust. I'm going to talk about grantor trust in a moment. May be gone. The 50-year limitation on how long a trust could last does not appear to be in the cards.
Could they add them later?
Well, I'm going to get there. And then the estate tax rate still remains on the House Ways and Means Committee at 40%. But this is not, Paul, this is not what's enacted into law yet. This is the House Ways and Means Committee. The Senate bill had lowered, we're going to talk about state tax exemptions. State tax exemptions under the Senate bill were $3,500,000 of exempt, and 45, 50, 55, 60, 65%, depending upon the size of taxation above that, which was quite confiscatory. Under this one, and that was not adjusted for inflation. Under the House Ways and Means Committee bill, we would drop from 11.7 million to 5 million, but that 5 million per person would be adjusted to about 6 million for inflation. So for a family, it'd be about $12 million and a rate of 40% of everything above that. So it's about half of what we had before. And we still have time and effort to lock in the almost $24 million worth of exemptions this year. But the last train's getting ready to leave the station. The lifeboats are leaving the Titanic. We have to act very, very quickly.
Yeah, because Harry, I know the firm is crazy busy right now helping people do this, right? I mean, we've never been busier.
Yes, we're in the midst of the largest intergenerational wealth transfer probably in the history of the United States of America, driven by these tax proposals. And this is to try to find a way to tax the rich to fund the $3.5 trillion spending bill. Not being Republican nor Democrat talking about this, I just think this whole thing is, they call it Build America Back Better Act. I don't think it's going to do anything more than hurt our capitalistic way of transacting business and some of the core values of the United States of America. So let's talk about a couple things. We talked about the capital gains tax getting changed effective September 21st, 2021, but we have two other things that are changing. One of the most important characteristics, or we'll call it aspects of our estate and gift tax system, is the use of discounts. So when we have an accounting for the purpose of a gift tax or accounting for the purpose of a federal estate tax, we have been able to always take discounts from the fair market value for lack of marketability, lack of liquidity, lack of control. And those discounts can range anywhere 30 to 40% of fair market value. So if we have an asset that's worth $10 million that you own, that you can't, it's not liquid, you can't market it, and you have no control over it, probably not worth 10 million. For estate and gift tax purposes, maybe it's worth 6 million, $6.5 million.
Big difference.
That's a big difference. That's like a $3 million change, and at 40% tax, that saves $1.2 million worth of taxes. And for people that have larger estates, the utilization of discounts is a very, very important tax aspect. So let's understand where this comes from. The IRS has never been in favor of intrafamily discounts. And most of the regulations that have come, or laws that have come out of Congress, have not been mandated by statute, but most of these discounts over the years have been etched into law based upon court decisions where the courts have felt that that's the case.
Yep.
Both the Senate version of the legislation and the initial House version of the legislation, those interfamily discounts are eliminated. And differing from other aspects, they would be eliminated upon the date of enactment. So not September 21st, not necessarily January 1st, but if they sign the bill into law on November 1st, 2021, as effective November 1st, 2021, we would no longer be able to use interfamily discounts. So we still have time to do that for gifting that may take place this year before enactment. I think that's a very important component to understand. So the other thing that I think that's important is the elimination of the utilization of what we call defective grantor trusts. As I said in my last webinar, the power to tax is the power to destroy. And what they're really after here is not only the changes in the rates and the amounts, but they're also after the tools that we use to help our clients move into generational wealth from one generation to another.
Trusts that have been around for many years, right?
Yeah, around for many, many, many years. But for many years, and not to wax politically, but the issue is whether or not there's been income inequality in the United States, whether wealth is concentrating in the hands of a fewer families. That's why the Senate Act was the 95-5 Act. In other words, where they felt that 5% of our country had more wealth than 95% of our country. Right. Good, bad, or indifferent, utilization of the tax code to equalize that is one of the goals of the dominant political party of our times. However, we've always had tools to work with it. And one of the tools we worked with is something which is called gifts using grantor trusts. And in terms that people may be able to relate to, that's where we would set up qualified personal residence trust to help save estate taxes on the transfer of our residence, our homestead, to our children. Also, something known as grantor retained annuity trusts. Also, what we call sales to intentionally defective grantor trusts. Inherently, in those particular types of transactions, those transactions would be effective for estate and gift tax transactions, allowing us to move assets to the next generation and allowing the grantor or our client to still have the income tax benefits or detriments of those particular assets. So for income tax purposes, they were not transferred, but for estate and gift tax purposes, they were. So an example for that on how, although this may sound counterintuitive, how that was helpful is that in situations where we've made a gift to children or a trust for children, and if Harry is able to pay the tax, pays the tax on behalf of the trust for my children, two things occur. One, my estate goes down by the amount of tax that I pay, and my children's estate rises logarithmically because their trust and they are not burdened by the tax because dad is able to pay the tax. So they have the asset. That asset basically grows tax without tax interference. My estate goes down. Very, very good technique. And due to a series of IRS regulations, the amount of money that I'm paying in taxation on behalf of my children, I could pay $200,000, $300,000, $1 million worth of tax on behalf of my children. That was not considered a gift. So that $1 million bypassed the 40% or $400,000 worth of estate taxes.
Well,
So in both the Senate version and the House Ways and Means version, effective with the date of enactment, not January 1st, 2022, if that occurs earlier, that ability to use grantor trusts for estate planning purposes is eliminated. So that basically means that my ability to pay the tax on behalf of my children would be eliminated. If I sold assets to an intentionally defective grantor trust on behalf of my children, there would be tax on that sale. A lot of the benefits that we used in intergenerational transfers, spousal lifetime access trust, and the other trust that I just articulated for you would be significantly impaired. And the other thing too is that we had one thing that's not in the House Ways and Means Committee talking about gifting and was in the Senate bill. In the Senate bill, they were trying to reduce our gift tax exemption down from current 11.7 million to $1 million. So it'd be 3.5 million for death and 1 million for gifts. And it appears that that is not the House Ways and Means Committee still keeps the amount unified. So if I have $6 million at death, I also have $6 million during lifetime that I can give away. So what this all means is that change is about, Paul. And like I said earlier, the last train is about ready to leave the station. We all do understand that none of this is enacted as of yet, but more likely than not, a good percentage of it will be. We were, I think, kind of lucky that at least so far in the House Ways and Means version, the step up in basis on death, still a very powerful tax tool, still remains in effect in the United States of America. And I'm very glad to hear that. So I encourage everybody, this is it. Yep. We may have to do simplified trusts to start, and then deal with them later through the use of protective powers, nominee agreements, and powers of appointment, so we can get things done within the time frame. We'll be stabbing in the dark somewhat a little bit on evaluation till we can get formal valuations, because the appraisers, my God, they're as busy as ever before. But there's still a little bit of time left, and then very shortly there'll be no time left to do this. So we'd still encourage everybody. We'll do our best to help everybody that we can up until the last minute that we can effectively help, at least assess and see what they can do to make this tax situation better for them this year. One winner in all of this legislation appears to be charities. The use of private foundations, donor advised funds, charitable remainder trusts, and other charitable gifts to help lower income taxation appears to be very well entrenched for next year. And it wouldn't be fair I wouldn't be Harry if I didn't say that the overwhelming need for asset protection is, if to protect our assets, the taxation being one form of asset protection is still overwhelming as a result of COVID, as a result of just being in America and the most litigious society in the world. And with that, I think that's a pretty good update of what's going on. We'll try to keep everybody up to date, Paul, as best as we possibly can. We have our whole team standing by and doing the best that we can to help everybody through this very difficult period of time, and doing the best that we can. And I thank everybody for joining me today, and I look forward to speaking to you all again really soon.
Thanks, Harry. Awesome. You obviously have your thumb on the pulse of all of it. And for all of those watching, wherever you're watching this, because we stream these episodes on Facebook, LinkedIn, YouTube, around this video somewhere, you will have the opportunity to get one-on-one with Harry and the team for a complimentary assessment. We're doing a ton of those right now. Get with us, whatever you have going on, small, medium, or large. We're happy to take a look at it, and we'll look forward to talking with you. Thanks so much, Harry.
Thanks, Paul.
All right. Bye.